This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
Welcome to The Interest. I'm Christine Stewart, and we're here in Vegas for Maximum Acceleration, the NonQM Summit, and Originator Connect. In just 24 hours, we're going to hear from a panel of brokers about how to be a better broker and how to sell non-QM loans. And it's happening here at Planet Hollywood. Now we're going to toss it over to our own Mike Savino.
Thanks, Christine. I'm sure a lot of lenders have questions about non-QM loans right now. On the one hand, mortgage applications have reached a 22-year low, and working with borrowers who were previously shut out can help balance that. But on the other hand, many non-QM lenders have not performed as well as expected this year. Our own Katie Jensen has a look at what answers you can get at Friday's NonQM Summit.
Forecasts for the non-QM sector changed drastically over the last few months. Major non-QM lenders like Angel Oak predicted volume to double by the end of the year, but the recent bankruptcies from other non-QM lenders like Sprout Mortgage and FGMC tell a different story. As a result, lenders have had to moderate their predictions. Angel Oak Chief Marketing Officer Steve Winokur believes non-QM will continue to grow due to growing demand from consumers.
I think that we'll expect to see some growth in the non-QM sector. The one thing that is for sure is that borrowers in this space aren't going away. There are more self-employed borrowers than ever. There are more property investors than ever. So while the markets are volatile and things are shifting all the time, the need and the demand from these underserved borrowers are not going away and will only continue to increase as the year goes on.
Despite recent volatility in the non-QM sector, we're seeing more lenders enter the space. United Wholesale Mortgage continues to roll out jumbo and ARM products, showing no fear over securing investor funding.
Well, lenders are getting in because the rates are on the rise, so the agency business is becoming more competitive. With rates going up, refinances have all but dried up completely. So lenders are looking for different areas to grow their business or at least protect their business.
In July, news broke that Sprout Mortgage was shutting down because they could not secure funding from their investors. Sources have told NMP that Sprout was selling its mortgages to JP Morgan Chase, but the major financial player reduced its mortgage staff due to the downturn in the housing market. Winokur explains investor sentiment towards non-QM loans and why they're shying away now.
Well, with the rates rising as rapidly as we've seen, that's impacted the non-QM secondary space. Without a government backing, investors are looking for a higher level of spread to cover their risk. So when rates went from, and the non-QM rates went from the 4s and 5s to the 6s, 7s, and 8s, that caused some disruption in the market. And so when agency rates went to like 5 and 6, the challenge was investors could look at investing in non-QM loans with a coupon in the 5s or an agency loans with rates in the 5s. And so what happened was there was a slight period of time where there was some disruption in the space because investors weren't as interested in non-QM loans that were paying 4 to 5% when they could buy agency loans at the same rate.
But Winokur says there's no reason to fear. These aren't the same subprime loans that we saw before the 2008 housing crash.
The important thing to remember is that this is not a credit problem. These are all good quality performing loans. It's just an issue with the coupon rate, and when the fact that rates rose so fast, it caused some disruption. But we don't believe there's anything to fear. Like I said, this is not a credit problem. These are not bad loans. Investors still love these loans. We still hear from investors every day wanting to invest in our securitizations. So it's just a little bit of a challenge right now, kind of flushing through the lower coupon loans and getting those out in the market. But we anticipate that happening and everything going well for the rest of the year.
More importantly, brokers and loan originators don't want to worry about financing issues that their lender might be facing, which is why partnering with the right lender is so imperative.
Well, I think that's I think you're dead on correct. It is more important now than ever to focus on working with the right non-QM lender. I believe Angel Oak's the right firm because of our vertical integration. So we have our own capital markets group that we work with on a daily basis that's very in touch with the secondary market. So we know what investors are looking for. We've adjusted our guidelines over the last several years, one starting with COVID and then just as things shifted over the past couple of years, we keep our guidelines adjusted regularly because we understand what the secondary market is looking for. So we don't look for loans or write loans that aren't able to be sold on the secondary market.
Steve Winokur and VP of Business Development Eric Morganson and Regional VP of Sales John Wise will be at the Originator Connect conference in Vegas this year to discuss what's happening in the non-QM sector and how loan originators and brokers can use it to advance their business. Additionally, other non-QM lenders like Acra Lending, NewFi, Carrington, A&D Mortgage, and others will be there to educate attendees on non-QM loans and show their confidence in this growing sector of the industry.
With all the recent changes in non-QM and the importance and increase in demand for non-QM programs, please join us at the NonQM Summit to learn more about non-QM, how to sell it, the current state of it, what investors are looking for in that space, and how to find and market to these borrowers. There's no greater time than to get into non-QM than today.
Attend the Originator Connect Conference NonQM Summit in Vegas on Friday, August 19th to hear from more non-QM experts. From the Mortgage News Network, I'm Katie Jensen.
You do have to pre-register for Friday's NonQM Summit. You can do that at originatorconnect.com. And while you're there, you can check out the full list of speakers, panels, and seminars throughout the weekend. Meanwhile, many lenders are working with past borrowers to help them leverage their home to get cash. But should they go for a cash-out refi, or should they take a home equity line of credit? Our own Christine Stewart asked an expert.
Not as favorable a choice for consumers just because of how quickly rates have risen.
Higher interest rates threaten to slam the brakes on what was a booming cash-out refi business over the last 2 years. But homeowners are still sitting on a lot of home equity at the moment and may need to tap into that.
I think cash-out refinancing, there's still some benefits, but a lot of consumers may be reluctant to replace that rate just to take out some extra equity.
Denny Cizak, a senior writer at LendingTree, says there's still a market for the cash-out refi.
There's still an advantage to using your equity to improve your financial position and even improve your credit scores so that when you borrow in the future, if you've got a lot of revolving debt, your credit scores may have taken a big hit. So cash-out refinance can help you clear that out.
But what if a recession hits?
I think if we hit a recession, as long as the job market stays consistent, I think that we'll probably see a slowdown in the rate of appreciation in housing, and the housing market should stay stable.
Who is a better candidate for a cash-out refi versus a home equity line of credit?
So I think the cash-out refinance borrower is maybe not quite as strong in credit scores, maybe has a score below 700, isn't going to get the best rates that they could get on a home equity line or a home equity line of credit. And they need a little more flexibility to qualify.
Cizak says a home equity line of credit may be a better product for consumers who don't need the money but may need a little bit of a cushion. For the Mortgage News Network, I'm Christine Stewart.
And finally, more layoffs in the industry. This time it's Blend Labs. Blend reported a $478 million loss in the second quarter, and the company has responded by cutting 25% of its positions. That amounts to about 420 jobs cut since April. It's the second straight quarter that Blend has reported a loss. The company pointed to a nearly $400 million impairment of intangible assets and goodwill. We'll be right back after a word from our sponsor.
This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.